Hello class, this is Dr. Fenton. In this video, we're going to cover Chapter 1 of the Accounting 201 course. This chapter is titled Managerial Accounting and Cost Concepts. So, let's get started. Now in this course, we are going to talk about managerial accounting and how to record items into various accounts and prepare reports that managers need for decision-making purposes within the company. In the previous course, we talked about financial accounting, and there were certain rules and procedures we had to follow. We had to record items a certain way. We had to prepare statements a certain way, especially the income statement, balance sheet, and the cash flow statement. So we were pretty locked into the rules we had to follow. Now in this class, we can have reports made, prepared any way we would like that give good guidance and good information to managers for those decision-making purposes. So as it says here, managerial accounting is concerned with providing information to managers within an organization so that they can formulate plans, control operations, and make decisions. Now, we can prepare statements and reports any way we would like if they're kept within the company. It's not that they're not going to be valuable. They need to be done in a valuable way. So we can divide cost a certain way, divide revenues a certain way, anything we need to do to get the appropriate information to managers within the company. Now, once we start taking numbers outside the company, like we did in the first accounting course, when it's called financial accounting, we need to make sure that we do record items certain ways and prepare statements in the regular format. So down here, we look at summary of cost classifications, and this covers a lot of new terms here that we're going to talk about in this chapter. So I don't want to go through this in detail, but you can see here about, for example, preparing financial statements like we did in the previous course. Well, in this course, we can break these out into product cost and period cost, and even further, we can break those down into variable, fixed, or mixed cost. So we're going to see a little bit of difference from the previous course, but we're going to see that we're going to give a lot of good information to those managers in the company. Let's start out with this, a direct cost. Now you can see the definition. Direct cost is a cost that can be easily and conveniently traced to a specific cost object. Now what is a cost object? We'll talk about more in a minute about that, but it's just something you're trying to identify, like a certain item that you are producing. It could be, number of units of a product. It could be machine hours you're using to produce a product. So a cost object is something that can be, a cost can be traced to if it's a direct cost. Now an indirect cost is one that cannot be easily and conveniently traced to a specific cost object. So for example, while the company soup factory managers, the manager's salary, factory manager's salary, is an indirect cost of manufacturing the soup. It's a direct cost of the manufacturing division. So if that person oversees manufacturing in general, then that is a direct cost to manufacturing. But to manufacture a specific product among many products that you're manufacturing, it's going to be an indirect cost to a specific product, like in this case, chicken noodle soup. It'd also be an indirect cost to tomato soup that Campbell produces. But when you look at manufacturing overall, it is a direct cost to the manufacturing division. Go to the next page. So let's look at manufacturing cost. In this course, when we're talking about managerial accounting, we are going to talk for a number of chapters about manufacturing items in the company. So we're going to take in raw materials. We're going to hire our own direct labor. We're going to spend money on manufacturing overhead, put all those together in the production process, and then come up with the finished product. So let's look at manufacturing cost. First of all, direct materials, also called raw materials. And this can be, the wood pulp, iron ore, other wood, steel, whatever goes into the product. And these can be traced directly to the product that's being produced. They can be traced and easily traced to that product. So if you're going to make, wooden furniture, Well, a direct material would be the wood you're using in that product. And let's see, direct labor, second category. I have three categories here of these costs. Direct labor. These are labor costs that can be easily traced to individual units of product. So, for example, my quick example a minute ago, you're making wooden furniture. The raw materials will be the wood. Then you have to have someone who is handling the wood, cutting the wood, shaping the wood, putting it together. Those labor costs are called direct labor. Okay, they are directly working on that product. If you look at an assembly line for like a car manufacturer, then the people on the assembly line, their labor costs are called direct labor. And just a quick, another definition. I mean, we have a lot of new terms in this chapter, a lot of new terms. So prime cost here, those would be direct materials plus direct labor cost. That's just the definition of prime cost, direct materials and direct labor. Now, the third main category of manufacturing cost will be manufacturing overhead. And we're going to see in the next couple of chapters, this is the area that will give us the most problem. There's a lot going on here. Manufacturing overhead cost, these would be all of those other manufacturing costs that you need to manufacture an item, except for direct materials and direct labor. Everything else is manufacturing overhead. So that would be depreciation on the factory building. It'd be the utilities on the factory building. It would be the supervisor's salary. Talked about that a minute ago. It would be insurance on the equipment on the building. It would be, things like property taxes on the building and so forth. So everything else that is a manufacturing cost that you're incurring because you're manufacturing a product, after you take away direct materials and direct labor, that is called manufacturing overhead. And then another quick definition, conversion cost, look at this. This is the sum of direct labor cost plus manufacturing overhead cost. Again, so conversion cost will be these two added. If you noticed, we had the prime cost definition a minute ago. That was direct materials and direct labor. Conversion cost has direct labor and manufacturing overhead. So direct labor goes in both of those definitions. Now, non-manufacturing cost will be those other costs involved in running the company and selling the product. So it says we have two different categories here, selling cost and administrative cost. And of course, selling cost be advertising, shipping, sales travel, sales commission, sales salaries, and cost of the finished goods warehouses, the buildings where the finished goods are sitting in before they're sold. Now, the administrative cost will be things like executive compensation, general accounting cost, secretarial, public relations, and similar costs involved in the overall general administration of the organization as a whole. So you have manufacturing costs that relate to manufacturing the product. You can think of the front offices will be the administration, and in the back of the property you have the manufacturing building. Any costs you're incurring back there in the manufacturing building, those will be manufacturing costs. Almost all the costs in those front offices will be the administrative cost. Now, if you happen to have like a cost accountant working in the front offices, the reason you have the cost accountant is because you have the manufacturing facility. So that cost would be an overhead cost for manufacturing. So we have two general non-manufacturing costs, selling and administrative. And overall, we have two kinds of costs for the company. That would be what we just talked about up here, the manufacturing cost and then the non-manufacturing cost. Now, as I said a minute ago, there are a lot of new definitions in this chapter. So this is not a chapter that is just an easy one to read through. That's like an introductory chapter. This hits the ground running. It throws a lot of definitions at us, and we will use these new terms and definitions throughout the rest of the course. So product cost. This includes all costs involved in acquiring or making a product. It says acquiring here because if you are a retailer and you don't make the product yourself, then a product cost would be the cost of the product that you're purchasing, the inventory, and the cost involved in getting that to your place of business. But in this course, we're concentrate on manufacturing a product, this would be all the costs involved in making a product. And again, you can go back to the direct materials, the direct labor, and the manufacturing overhead. Those are product costs. Those are also called inventoriable cost, because we're going to see in a minute, in fact this paragraph right here, that whenever you purchase raw materials, whenever you start working on a product in your manufacturing process, and after you finish it, all those costs, all costs involved to that point, are placed into an inventory account. So they are inventoriable. Okay. So for example here, when you buy raw materials, you do have a raw materials inventory account. So if you buy the wood or the steel or the plastic, whatever that's going to go into your product, you will debit the raw materials inventory account and credit cash or accounts payable. So you do have a raw materials inventory account where you put the cost of the raw materials when you buy them, and they will sit in that account until you start using them. Now once you start using the raw materials into production, that cost will be transferred into the work in process account. And the work in process, and this is an inventory account, so the work in process inventory account will accumulate while the item is being produced raw material cost, direct labor cost, and manufacturing overhead cost. So work in process will accumulate all three of those manufacturing costs. Once the product is finished, then the entire cost of that finished product is then transferred into the finished goods inventory account. And so this represents the cost of the items that you produced. Now they're ready to sell. And so until you sell those items, all those costs involved, all the materials, labor, and overhead you incurred to make the product, all that cost will sit into the finished goods inventory account until the product is sold. And then, just like we saw in the previous course, when you sell an item, then the cost is transferred to the cost of goods sold account. So the three inventory accounts we have in this course: raw materials inventory, work in process inventory, and finished goods inventory. Then going past that, we have the regular cost of goods sold account. Those are product costs involved in making the product. Period costs are all selling administrative costs, and they're treated as period costs. These are not incurred to produce the product. These are incurred to sell the product, to keep the company running just in general, but these are not specifically tied to making the product itself. Period costs are expensed in the income statement, okay? Whereas product cost will go through those inventory accounts we talked about. Now, here's a chart. It shows what I've been talking about. So the cost involved. When you purchase raw materials, it goes into the raw materials inventory account. Now this is a very good chart. The cost will sit there until the materials are used in production. Then the cost is transferred to the work in process inventory account in the accounting records. And the work in process inventory account is also used to accumulate the direct labor cost involved and the manufacturing overhead cost involved. So all the manufacturing costs, all three, materials, labor, and overhead, end up going into the work in process inventory account and will accumulate here until the product is complete, is finished. Now when it's finished, then the goods will be transferred to the finished goods warehouse, and the accounting numbers will be transferred from the work in process inventory account to the finished goods inventory account. So far, all these costs we've incurred are in one of these inventory accounts. They all end up in work in process and then transferred to finished goods inventory. As I said earlier, the cost will sit here until you actually sell those products. So when you sell these products, then you'll transfer the cost out of finished goods inventory into the cost of goods sold account. Now this finished goods inventory account, if you want to think about this and relate it to your first accounting course, this would be like our merchandise inventory account we had in the balance sheet. The current assets, we had inventory, sometimes called merchandise inventory. That represents the cost of the product we purchased. It's ready to sell. In this situation, we are incurring all these costs to produce the product, And once it's produced, then the costs end up into the finished goods inventory account. And when they're sold, into the regular cost of goods sold account. All the period cost, selling administrative, they go straight to the income statement. They do not go into these inventory accounts. So they go straight to the income statement. So very good example right here. Next page. More definitions, more definitions. Let's look at cost behavior. Now, a variable cost will be a first one here. It is a cost that in total varies with the level of activity that you're looking at. So if you're producing more product, then you're probably using more wood, more steel, more plastic. That's a variable cost. The more you produce, the more this cost will be. The less you produce, the less this cost will be. So we have a variety of items. Usually direct labor is a variable cost. We have some variable elements of manufacturing overhead, like indirect materials, supplies, power. So the more you produce, the more of these you will use. Now, here's an example here. We have cost of meals per guest. And we have a expedition company, and they provide gourmet meals to its guests. So if they have 250 guests, and the meal cost is $30 per guest, multiply, and total meal cost will be $7,500. If you have, let's say, 1,000 guests at $30 per meal per guest, multiply, the cost will be $30,000. So we're going to see in a minute that total cost for variable costs will increase as the activity increases. The per unit cost stays the same. So no matter how many meals you have, it's always $30 per meal, but the more meals you have, the more total cost you have. Here's a graph. So if you don't have any guests, like in this previous example, you don't have any cost for the meals, zero. But then the more guests you have, the more the cost will be. So that at 1,000 guests, here it is, $30,000, and anywhere in between. So the fewer guests you have, the lower the cost. The more guests you have, the higher the cost. Now, what's an example of a fixed cost? They sort of throw this chart in here, right here, the cost of the building rental. We haven't really talked about fixed cost yet. But if you, in their example here, if they rent a building for $500, it doesn't matter how many guests they have, they still pay the rent of $500. So whether it's no guest, 250 guests, 5, 750, 1,000, this is a fixed cost. It stays at $500. So this is not a variable cost because the total stays the same no matter what activity level you are at. Now, a fixed cost is just opposite. Just talked about that. Remains constant. It's opposite from the variable cost. So regardless of the changes in level activity, a fixed cost in total remains constant. So if you go back to that building rental, again, it doesn't matter how many guests you have, the total cost is still $500. But if you divide like 500 by 1,000, if you end up having 1,000 guests, then this cost, this $500 cost spread over 1,000 guests is only 50 cents per guest. Whereas if you have 250 guests, spread 500 over that, it's $2 per guest. So that's one thing about your fixed cost is that in total, fixed costs do not change, no matter the number of units, in this case guests. But the more units you have, the less the fixed cost is per unit. Variable cost per unit stays the same. Fixed cost per unit does go up and down depending on if you have less or more, like in this case, more activity. All right, now you get into fixed cost a little bit more. We can break these down into committed fixed cost versus discretionary fixed cost. Now, committed fixed cost, these are the ones you're committed to. In the short run, in the foreseeable future, you cannot change these costs. These are locked in. Maybe you're under a multi-year lease. And so doesn't matter what's happening with your number of units, number of guests, or whatever, you're locked in. You're going to be paying that rent every month for the next 2 or 3 years. That's committed. You're locked into it. Now, a discretionary fixed cost, even though it's fixed and doesn't change as to the activity level going on, you can elect not to pay this. So an example would be like advertising, another research, public relations. So this is a fixed cost in the fact that in total, it will not vary with the number of units you have, but it is a cost that you can just decide, I'm not going to pay it. I'm not going to advertise, for the rest of the year or whatever. So it is fixed when you pay it, but it's also discretionary so that in the short term, you can elect not to incur this cost. Let's look at this linearity assumption and relevant range, and let's look at this example. Now, we have here, to help explain this, that the Mayo Clinic rents a machine for $20,000 per month, and it can provide 0 to 3,000 tests. So at $20,000, they rent one machine. Here are the range of tests it can perform. But the Mayo Clinic gets high demand and they need to go over 3,000 tests for a month. They need to lease another machine. And so at 2 machines, here's the cost. So within this range, within this relevant range from 3,000 to 6,000, the total cost is $40,000. It was $20,000 under this range. Now jump up and we have another range, the cost higher, and they have to go over 6,000 tests, then have to get another machine. Now they're paying $60,000 a month in the rent. So this is a relevant range within each of these categories. Once you get past this relevant range, then the assumption changes. We have to jump up a cost. This is also called a step cost, because you can see a little stair step here. And so we have this range at a certain cost. You go past this point, it jumps. It's not a smooth line. It jumps like another machine to be rented. And then another one. This is called a stepped cost. Here, step-oriented cost behavior pattern. That's what that is. So here's a summary of your variable and fixed cost behavior. So once again, for variable cost, in total, they will increase and decrease as your activity level increases and decreases. But per unit, it stays the same. Okay, so think about that. Per unit's the same, but when you have more units, you have more total cost. Fixed cost, just opposite. Total fixed cost will not change even as your activity increases and decreases. But if you want to compute a fixed cost per unit, then it will decrease as your activity increases because you're spreading that total fixed cost over more units. A mixed cost is a certain cost that has both a variable and a fixed element in it. The example they give here is, let's say, a license fee. So you have a rafting company, and you have to pay $25,000 per year to the Department of Natural Resources in your state. That's just to have a license, probably, to take people kayaking. Then, on top of that, you have to pay $3 per rafting party. So you can see it's a fixed cost plus a variable cost. And to chart that, down here we go. To chart this, then you're looking at the cost behavior for this fee you pay to the state. Well, when you first start, even with no customers yet, you pay $25,000. But then the more rafting trips you have, then you add a cost on top of this fixed line here, and the total cost keeps going up. This is the variable line. This is the total cost line, but showing the variable portion of it. And you add it on top of the otherwise fixed cost. So this is a mixed cost, part fixed and part variable, because it does increase in total as the activity increases. And here's an equation that you can look at. Let me go back down slightly right here. The equation y equals a plus bx. Y is the total mixed cost. A is the fixed cost portion. B is the variable cost per unit, and then X is the level activity. So if you're looking at 800 rafting parties, here's the formula for the rafting company. The fee to pay the state, $25,000 plus $3 per unit of activity, a rafting party. And so plug the numbers in, $25,000 fixed cost plus $3 times 800 totals to $27,400 at the level of 800 unit activity. Okay, next page. Differential cost and revenue. We'll touch on it here with these definitions, but we'll cover it more closely in a later chapter. Now, I guess the thing you need to know in this chapter at this point is that the definition of a differential cost is just a cost that in total differs between any two alternatives. So choosing one alternative or the other one, this is a differential cost because the cost differs between the two alternatives. Differential costs are always relevant. You're trying to make a decision. If one costs less than the other, then you have a number that's relevant to your decision, lower cost or higher cost. Same way with differential revenue. It's a revenue that differs between alternatives. It's always relevant to a decision. A differential cost, also known as incremental cost. And then if you think about your economics course, then the economists call this marginal cost and marginal revenue. And those terms are just fine. They use those. Accountants will usually use differential cost. Sometimes we'll use marginal cost, marginal revenue, but we'll oftentimes use differential cost or differential revenue. And they can be fixed or variable. I'm not really worried about this presentation here. Don't worry about it. Sunk cost, another definition. A sunk cost is a cost that has already been incurred, cannot be changed, and doesn't make any difference to a decision made now or in the future. It's a sunk cost. Sometimes it's hard to think of a cost as a sunk cost because you may be paid for something and now you think, well, should I sell the item or not? What you paid for something doesn't make any difference. It's what you can get for it now. So a sunk cost is any cost that's already been incurred, you cannot change it, and it does not make any difference in a decision now or in the future. An opportunity cost, on the other hand, is a little bit different. You look at the differences between your alternatives on what would have been the selection over that you made over the one that you could have made. So, for example, let's say alternative 1 would give you $10,000 in profit. Alternative 2 would give you $8,000 in profit. So you choose alternative 1, and that's fine. Maybe that's the best decision. But for you to choose alternative 1 to make $10,000, you're giving up $80,000. Now, that's fine, but you just need to know and look around for any opportunity cost that you might incur by choosing one alternative over another. Okay, next page. Let's look at these different formats. And so for internal management purposes, we can have an income statement that is called the contribution format income statement. Let's look at this example here. Now, in the previous course, we prepared an income statement that looked like this. Okay, this is a very condensed version, but we had sales, we had cost of goods sold, we had gross profit. We had selling administrative expenses. Sometimes this is called operating expenses. That's fine. And then we have net operating income, let's say of $1,000. So this is what we learned in the previous course. Sometimes managers want to know the difference between the variable and the fixed cost. Because variable costs, they can change with different levels of activity, whereas fixed costs, they cannot. So sometimes this gives you more, some people might say better information about your own company. Sales, still in here. But instead of just having cost of goods sold, like we do here in one number, we have variable cost, and then we show the variable cost that are within cost of goods sold. And so $6,000, and I guess they're saying all their cost of goods sold are variable cost. That may or may not be true. That would be true, I guess you could say, in a retail company. But then you have variable selling expenses, variable administrative. These are all your variable costs, total of $7,000. And now, instead of instead of gross margin or gross profit, we have contribution margin. So your definition for contribution margin is simply revenue, in this case sales, minus total variable cost. That is contribution margin. It's as simple as that. Contribution margin is revenue minus variable cost. That is not the same thing as gross margin or gross profit. Gross profit is revenue minus cost of goods sold. This is different. Once you have contribution margin, then you take away your fixed cost, and you have some fixed selling and fixed administrative. Put those down here, total fixed, and now net operating income is $1,000. Now we're going to see later on that you don't always get the same bottom line figure between the traditional format income statement and the contribution margin format income statement. At this point, you need to know how to prepare one of these. Start with your sales, then list all your variable costs, get the total, subtract, get contribution margin, new term for us, then list your fixed cost, total, subtract, and get net operating income. Okay, and again, this is more explanation about it. It shows a distinction between fixed and variable cost. And really that's about it. Let's go to the next page. Well, it looks like we're at the end of the chapter. So again, go back and read the chapter in detail yourself. Hopefully you'll use my explanation to help get you through those examples and the explanation, but read it yourself. Follow all the numbers through in the examples. Okay, that's what you need to do on your own. All right, so that's the end of the chapter, and good luck with your studies.